Hi, welcome back to my CFA ESG exam channel. Well, this episode is for chapter 2, but then before going to chapter 2, could please have a look at my tablet here. Well, these are the important concepts we met for chapter 1 and see whether you can remember any of those. And in case you don't, then please go back to chapter 1 before we're continuing. And moreover, please remember to finish the self-assessment question at the end of the chapter. And note that for the actual exam, the pass mark is around 70. So after finishing the self-assessment questions, please compare your score against this pass mark. So let's begin chapter 2. Right, so this chapter 2, and again we start from learning outcomes. There are 4 of them, and I explain each of them one by one in subsequent slides. The first learning outcome is to explain history of ESG investing. So this part of the chapter is to explain a few important concepts and where these concepts are from. Well, the first concept is about sustainable development, and it came from a report called Our Common Future, which is also called Brundtland report. Brundtland report was the person who was responsible for this report, and then this report was the effort of the United Nations World Commission on Environment and Development. And the second concept is ESG investing. Well, this began relatively long time ago, close to a century ago, with the Pioneer Fund and then also the so-called Pax World Fund. And not surprisingly, that began by negative screening. And the other important milestone of ESG investing was a so-called investor divest movement during South Africa's apartheid era. And there was a so-called sovereign principle, which says that a company should treat all employees regardless of race equally. And for a company that doesn't follow sovereign principles, the investor should divest from that company. And then, well, finally, where does the term ESG come from? Well, it came from a report called Who Cares Wins, Connecting Financial Markets to a Changing World, and it's an effort of then United Nations Secretary General Kofi Annan, who urged CEOs of major financial institutions to integrate ESG factors into capital markets. Right, the second part is to explain the size and scope of ESG investing in relation to geography, strategy, investor type, and asset class. So, well, the latest figure is as of 2 years ago, and the AUM sustainable investing assets were about 35 trillion. To give some context, the total global AUM is actually a little bit over 100 trillion. So the share of sustainable investing assets is roughly 1/3 of global AUM. And then within this 35 trillion, half is in the US, and about 1/3 is in Europe. So how's the penetration of responsible investments? So Canada is the highest, at more than 60%, Europe a bit over 40%, and then US and Australia between 30 and 40, and then for Japan, there's roughly 1/4 of investments are deemed responsible investments. And then, well, for ESG investing, there are a number of strategies. Globally, also in the US, the main strategy is ESG integration, but then in Europe, the main strategy is mainly negative screening. And then what's the mix between institutional and retail participation? Well, the figure is a bit old, so maybe, well, the figure right now is a bit different. 10 years ago, 90% of such responsible investments were institutional, and then only around 10% retail. Nevertheless, well, the reminder that, well, for the millennials, that is the people who were born between 1981 and 1996, seem particularly interested in ESG investing. And then, well, the number of such millennials were roughly 75 million, or about 1/4 of US population. And they're important in the sense that they are future recipients from intergenerational wealth transfer through inheritance from baby boomers. So what's the asset type mix of responsible investment? So roughly half is in public equity. So it pretty much means that, well, the biggest asset type of responsible investment is in public equities, and the fixed income is about 1/3, and the others, like say real estate, their shares are a lot smaller. Right, the third learning outcome is to explain the key market driver ESG integrations, and then also say investment demand, regulation, policy, awareness, data source and processing. Now the main stakeholders, well, here are the main stakeholders of ESG integration. So they'll include asset owners like say pension funds, insurance, sovereign wealth funds and foundations, asset managers, fund promoters, well, kind of like say the salespeople of funds, financial service providers like say banks, research firms, stocks exchanges, financial ESG rating agencies, policy holders and regulators, investees, government, civil service, society and academia. Right, the learning outcome number 4, well, it's actually, well, kind of similar to, well, the previous one, but then it says that, well, we also need to explain the challenges among key stakeholders. So let's begin with asset owners. So asset owners, well, there are a number of different types of asset owners. So the first one will be the pension funds. Pension funds, they are very long-term liabilities, so therefore they by definition are long-term investors, and therefore they are considered well-positioned in influencing the investment market. In the pension fund, there are a few roles: executives, that is the people who run the funds, and then trustees. Well, trustees are the ultimate body with fiduciary responsibility, although be reminded that the asset manager is primarily responsible for fiduciary matters. So actually, well, from time to time we saw questions asking, say, within say trustee, asset manager, etc., which party is responsible for fiduciary duties. So actually the correct answer should be asset manager, even though I'll say, well, the text here is a bit confusing or contradictory. And now, of course, well, for a pension fund, there are beneficiaries. Well, the beneficiaries, they may not be aware of the details, but then they may question the nature of investment, say whether they're controversial investments, well, they don't like, etc. And then insurance, well, there are a few insurance companies, say property and casualty or general insurance companies, life insurance companies, and other insurance companies. And because well, insurance companies will need to pay claims, so they are sort of double exposed on both asset side, that is on the investment side, and also on the liability side, with respect to ESG matters like say physical risk like extreme weather events, and also say for life insurance companies, the demographic changes. The third type of major asset owner will be a sovereign wealth fund. That is well kind of the investments held by countries. For sovereign wealth fund, apart from maximizing financial returns, very likely they also include a project objectives, for example, say to facilitate or enhance economic development. And then other types of asset owners will include endowment funds, foundations, or charities. Right, for the asset managers, well, this slide lists down the opportunities for asset managers and also the challenges. On the left-hand side, asset managers may influence portfolio ESG characteristics through selection, and also engaging with investee companies. And for ESG, asset managers may offer ESG products. Historically, well, these ESG products started from actively managed products, but then, well, as there are more and more ESG related indices, So the number of index links or passively managed products are growing very quickly, and right now there are more than 1,000 ESG indices. There was a challenges facing asset manager in terms of ESG integration. So the first one will be the lack of clear ESG signals from asset owners. Well, maybe the asset owners themselves, they are not really sure about what they want in terms of ESG, so therefore it's hard for asset managers to follow. And another thing is, well, the asset managers may have difficulty finding the right ESG related products, partly because, well, the advocates of these products, like the consultants, advisors, they may have very little interpretation of investment objectives. So maybe say they may think that integrated ESG issues may harm investment returns, so they may not want to promote or support such products. Of course, finally, resource challenges is an important thing. For example, asset managers may worry about the resources required for engagement, marketing, and compliance in order to implement ESG integration. Right, the other stakeholders like fund promoters, well, we actually encounter such in the previous slide. So that will include, say, investment consultants, retail investment advisors, investment platforms like Morningstar, and then also so-called fund labelers. And well, understanding that, say, the investment consultant, retail investment advisors, they may not be very well aware of ESG issues, and therefore they may be reluctant to promote ESG products. So, well, if you remember from the previous episode, the principle of responsible investment has an aim for these consultants to understand better ESG issues and turn them into investment recommendations, while they may, as they are now weak at understanding ESG issues and therefore promoting ESG products at present, as you've seen in the previous slide. And then finally, the financial services providers are, of course, major stakeholders, and then they will include, say, banks, rating agencies, stock exchanges, and then there are a lot of ways that they can contribute. For example, the banks can underwrite green bonds, and then research firms, they consider ESG factors in investment recommendations. Right, like chapter 1, it is quite obvious that the exam will want to ask a lot of questions about regulatory developments. So, well, please do bear this in mind and then learn these points by heart. So the first one is so-called the Task Force on Climate-related Financial Disclosure. This is a term that we met in the previous chapter. And then this TCFD has got a number of disclosure recommendations on several issues like, say, governance, strategy, risk management, and metrics and targets. And a related regulation is from the European Union called Sustainable Finance Disclosure Regulation, or maybe also abbreviated as SFDR. It is aimed at enhancing transparency to prevent greenwashing and to identify principal adverse impacts. And then, well, another very important piece of regulation, also from the European Union, is a taxonomy regulation. Well, the purpose of this regulation is pretty much, well, to have a official definition of what can be called sustainable investment. So pretty much to avoid, say, a lot of companies may label the investment as green or sustainable, and therefore there may be a lot of greenwashing. So the key points of this regulation are to state conditions for an economic activity so that it can be considered environmentally sustainable. And there are three conditions. Firstly, it has to contribute substantially to at least one of the 6 environmental objectives. And these objectives are those that you can see near the bottom of this slide. And then more importantly, this economic activity must do no significant harm to any of the other environmental objectives. So what does this mean? That means that, say, maybe there are 2 activities or maybe 2 investments. One of them do better than the other on, say, maybe a few, say maybe 2 or 3 environmental objectives. But then for the one that does better in a few objectives, is going to also have a highly adverse impact to one of the other environmental objectives. So given that it fails the so-called doing no significant harm condition, therefore even though it's doing better in other objectives, it will still not be considered as environmentally sustainable. And of course, finally, this economic activity will need to comply with minimum EU specified social and governance safeguards. So what are the 6 objectives? So here's the list: climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, and protection and restoration of biodiversity and ecosystems. Okay, we are now reaching the end of this chapter. Other stakeholders will include investors, government, and also civil service, so civil society and academia. Right, so this is the end of the 2nd episode. So thanks for watching.